welcome to World Insight. I'm Tian Wei from Beijing. Chinese policymakers have gathered in Beijing to map out the economic and reform plans for the year 2022. The conference, which has been held annually since 1994, is a key event as it sets the direction for priorities and key economic targets for the year ahead. The meeting agreed that China will comprehensively deepen reform and opening up with an emphasis on innovation. Also this year, China's overall trade over the first 11 months stood at 5.6 trillion US dollars, up by 22% from this time last year, with a 22% rise in exports. So what are the growth opportunities in China's economy's work plan, and what are the collaboration strategies amid a long pandemic? My conversation with the panelists. On the discussion of the Chinese economy, I'm joined by Wang Dan, Chief Economist of Hang Seng Bank, China. In Hong Kong, Hong Hao, Managing Director and Head of Research at Balcom International. Last but not least, in Singapore, Bert Hoffman from the East Asian Institute of National University of Singapore, former World Bank Country Director for China, Korea, and Mongolia. Welcome to all of you. Mr. Hong Hao, I want to start from you. Tell us what might be the impact of the latest policy changes regarding the bank reserve ratio for most of the banks in China. Is it going to unleash a lot of vitalities and funding for the Chinese economy?
I would be taking a cautious stance on the latest triple R cut. I think even though the triple R cut released a fresh 1.2 trillion yuan worth of liquidity into the system, but then in the middle of the December, you have 950 billion worth of MLF that is coming due. So this money has to pay back to the central bank. So I think the triple R cut is really to offset this MLF coming due, and I think the leftover liquidity could enter the system, but it's not that much. So I think the market is perceiving this cut as a release of fresh liquidity into the system. But I would say that people need to look at the macro picture. Even though the growth is slowing, but it's still relatively stable. But then at the same time, inflation pressure is still building up, both on the upstream and downstream. So I would say, even though the economy may need some help, but I think if you release fresh liquidity dramatically, it would actually increase the inflation pressure in the economy.
I see. Dan, what's your take?
Well, I do think this triple R cut will lower the lending cost for commercial banks, and that is quite significant. Although I do agree that fresh liquidity additionally injected into the economy wouldn't be that much, but the overall lowering the cost would help the commercial banks to be able to lend more to households, to corporates, especially now we have seen this deterioration in the liquidity situation for the property sector. And this triple R cut, I think it will directly help to relieve some of the pressure there.
Recently, some of the US-listed Chinese companies have been having quite some challenge as a result of changes in the United States in terms of regulations and laws. And now, Mr. Hoffman, what does that mean for China's international approach, shall I say, in this regard? What do you think will be the impact of that?
Well, the trouble comes a little bit from both sides. It's both China's regulations as well as US pending regulations that might affect the international listing. I think it would be a loss for China and a loss for the rest of the world. I mean, one of the key reasons for those companies to list internationally is to actually aspire to international standards and basically internationalization of the Chinese economy. And the Alibabas of the world and others, they have been doing that very well. And their internationalization strategy in part depended on that. If that were to be reversed, and I'm still hopeful that it won't, that would be a loss for both sides, for the world and for China.
Mr. Hong Hao, of course, after having some troubles in the U.S. Stock exchanges. Many of the Chinese companies are moving to Hong Kong, where you work. So, what would that mean? Is the Chinese economy going to turn much more inward because Hong Kong part of China, or this will be a temporary option?
Yeah, well, it used to be that the Chinese company like, going to the US, for capital raising, because there's abundant liquidity. I think the investors are more risk-seeking, and, the valuation you can get in the US market is quite good. But I think, now with the regulatory change, some of the companies may have to come back to Hong Kong, and may even go back to the Asia market for listing. Now, having said that, there is a grace period of up to 2 years. Within these 2 years, you can choose to comply with the new regulation, or you can choose to go back. And I think with the new regulation, all you have to do is to disclose your book and also disclose the government ownership in the business.
Mm-hmm.
So I would say that those are some companies may choose to comply with the new regulation, and some may come back. And for those companies who choose to come back, many of them, especially the leading ones, such as Alibaba, Baidu, and all that, they have dual listing in structure in the market. Now, with the U.S. exchange trading volume is substantially higher than Hong Kong listing, therefore, the U.S. Listing for now is the primary listing for many of these companies. But it's quite conceivable that if these companies choose to come back, because of the dual listing structure, people can easily exchange the U.S. shares for Hong Kong share, and achieve a very smooth transition for these companies to come back to Hong Kong. So I would say that with that in mind, many of the investors in these companies are actually mainland Chinese and Hong Kong-based investors. I think it would be more than half of them. For example, the Futu, one of the biggest online brokerage in China, 50% of the overseas trading account is actually Chinese accounts. So, I would say that it would be easier for these investors to trade if these leading Chinese tech companies choose to relocate back to Hong Kong.
So you got a lot of things going on these days, not only with the latest policies, but also with the latest development regarding where China is with the rest of the world. So with that in mind, what would that mean, Mr. Hoffman, about the economic prospect and the policy directions that China likely to take for the coming year? It's going to be a big year for China.
Well, I think we're at a very, very interesting point in time. The macro issues are still there, and China's growth is clearly slowing. So China would have to balance monetary and fiscal policies very well in order to maintain a certain level of growth. What that level is, I don't know. I'm sure that will be discussed at the Central Work Conference. But second, we've seen a lot of, if you want, developments in the new development philosophy. And I think next year might be a big year for getting that onto the ground and to get specific measures implemented that would match that philosophy. We've seen some measures in the regulatory sphere over the past year. Some people were a little bit surprised by them, but they were by and large in the right direction. But there's a lot more to be done on the common prosperity, on the green, on the dual circulation, all these big terms. Bringing them down to earth, I think, is going to be next year's agenda and beyond, because you can't solve these things in 1 year.
Well, a lot of daunting tasks, isn't it, Dan?
Oh yeah, all those tasks, I mean, they are very difficult to be done, even for developed economies, when they actually have the tools and enough capital to support that. And for China, I think there is also a very significant task on how to prioritize all those things and how to reallocate resources. And now it just looks to me that common prosperity and climate change are on the top of the agenda. All the other segments in the economy would have to somehow adjust to this new reality. So the capital will be redirected to those most productive high-tech industries. And for some of the low-tech, even if they can still provide employment, they're still profitable, they might have to suffer more just to make sure that we achieve the longer term goal.
But let me just ask you a little bit more in detail on the green thing. We did have some apparent power shortage in the year 2021, and there were discussions about the speed of how to achieve green. China made a commitment 2030, 2060, that is for sure, but how to make sure the speed and the pace are appropriate, that's one thing. The other thing is about the common prosperity. On the one hand, common prosperity, but on the other hand, as after the sixth session of the CPC committee during the press conference was indicated, it's not about sharing the wealth of the rich, but rather to create more wealth and to reinvigorate the economy. So these are very delicate balance that would require wisdom and policies. Dan.
Oh, absolutely. Regarding the power shortage, I take a slightly different view because China has overcapacity in almost all industrial sectors. And once something is in shortage, that means the price is wrong for something. So we have noticed that for electricity market, there are about 60% of the electricity having the fixed price. That is the price fixed by the government. Only 40% were allowed to fluctuate based on market demand and supply. So this year, starting from September, more regions are allowing electricity to fluctuate based on market demand, and they're allowed to go beyond the 20% fluctuation rate. So that's significantly improved already from what the government has been trying to achieve in the past 10 years. And then regarding the common prosperity, I definitely agree. We're not talking about killing the rich and or just getting more wealth from the rich and redistribute that to the poor. It's about the wealth generating ability for the low income people, especially the urban poor. Since they don't really own any of the substantial assets, at least the rural poor still have the land. So that's a difference. And there has to be some direct subsidies targeting those urban low-income groups. And I think the central bank digital currency can play a significant role in that.
Interesting. How?
Well, there are already pilot scheme in the past 2 years that the central bank distributing or simply distributing cash using this central bank app directly to people's account. So they would know what you have spent it on, when you spent it, and they would know your family income. So it's a very targeted approach. There was a concern that this might cause inflation pressure because we know that inflation is fundamentally a monetary phenomenon. So if you print more money or send out more money, the price level would go up. But I do think for what we're facing now, the market has a very good industrial performance, but the consumption has been very weak for 2 years. So this is a measure that probably would to the best interest of Chinese people.
We'll see how those important topics are to be discussed later in the year. Bert Hoffman, Dan Wang, Hao Hong, thank you so much for joining us. Really appreciate that. Thank you.